Welcome to another episode of DE Dealmakers, a podcast by Darrow Everett, a full-service business law firm with offices in 7 states. I am your host, Emmanuel Subar Litvinoff, a South Florida-based attorney in DE's corporate department. Today, we have the pleasure of hosting Steve Subar, a seasoned expert in the tech industry with a wealth of experience spanning from early-stage startups to companies generating over $100 million in annual recurring revenue. Steve is renowned for not only being my second cousin once removed, but for his keen insights into tech market evolution, mergers and acquisitions, and the impact of emerging technologies like AI on the competitive landscape. Steve's extensive background and strategic acumen make him a compelling voice in understanding how tech advancements drive industry convergence and reshape business strategies. Now join us as we delve into Steve's expert perspective on navigating the dynamic world of tech M&A. Steve, thank you so much for joining us.
It's a pleasure to be here, Emmanuel, and it's great to be able to do business with a cousin.
Appreciate that. Now, Steve, let's dive right into it. Can you break down the typical pattern of tech market evolution, particularly in relation to M&A?
Sure. So over the course of the last 30, 35 years, there have been a number of different patterns that have emerged around how technologies evolve and the impact that has on both sellers, buyers, and investors. And it usually goes something like this. Initially, when there's a new technology category, companies are looking for ways to deploy that. And most often what they have to work with is the raw technology itself. And at that early phase of that new market, the new industry using that technology, that means that it's for developers to figure out how to make it work in a particular instance. So there's typically a fair amount of software development, research and development, other kinds of innovation that's done by people who work for the organizations that want to harness the new technology. And while that's a good way to get a first start, if you zoom out for a moment and think about what is the business really trying to accomplish, it's most of the time not employing people to figure out how to use new technology. Really what they're after are the benefits or the result of having implemented that. And so this phase of the marketplace usually lasts for a relatively short period of time because it's quickly followed by vendors who have taken that core technology and evolved it to a next phase where it's more readily usable without as much investment by the end user. So during this phase, we usually see tools in technology, tools that are designed to make it easier to leverage that new technology and harness its capabilities. So in other words, it's a way of doing things more quickly without having to do them as much by hand. And while that's a great step in the right direction, it still doesn't really fulfill the ultimate objective, which is how to use that technology to its benefit without having to invest so much in making it do something useful. So the second phase, the tool phase, is then eclipsed by the application phase. The application phase is where the technology is now incorporated into the actual applications, which are the intended result that the enterprise or the small business is trying to accomplish.
That's quite interesting. So over the years, how have you seen the B2B tech landscape shift, especially since the pandemic?
Well, the pandemic had a great effect on how tech companies do business. And I think the single most important shift is how buyers and sellers establish trust. Whether it's a personal relationship or a business relationship, what hasn't changed since the pandemic is that trust is the single most important variable in deciding who to do business and how to do business. And as much as we've evolved to use technology to help with communication, there's no substitute for actually being together as probably the best way to establish trusted relationships. And so the pandemic's actually had a very marked effect on how technology is evaluated and how it's purchased and certainly how it's sold, because there's less and less interaction between the parties. For the most part, buyers would like to complete most of their journey without actually having to interact with the vendor. So vendors now have invested in ways of helping buyers on that journey essentially unaided with digital means so that they can do most of their evaluation on their own and then really only contact the vendor when they've created their own shortlist and are ready to engage in some more detailed questions. The problem with that is that it makes it extraordinarily difficult for the vendors to differentiate, and it takes away the opportunity for them to position their solutions based on the unique requirements of each and every potential new customer. So the pandemic has created this sort of separation that makes it much harder to build trusted relationships and makes it much more difficult for the vendors to understand specifically what the user's requirements are before they've created their first impression or maybe shortlisted who they want to speak with.
Well, what an obstacle that we probably didn't think was coming about 4 or 5 years ago. And once AI figures out personal relationships, then I think we're all in trouble.
That's a whole different discussion.
Yes. So, where do you think we currently stand in the AI evolution continuum? And how does this position impact M&A?
Well, in my view, current AI really needs a reality check. The world of AI is really abuzz with excitement, and for good reason. But generative AI models are certainly producing a lot of very impressive results. However, a trend has emerged that requires, I think, a closer look. Some vendors are marketing these models as capable of reasoning, and that is misleading private investors and the public. The ability to reason in AI would really be a game changer. I mean, a giant leap in truly intelligent machines. But here's the key point. These large language models that you hear about, they're not there yet. They are incredibly skilled at pattern recognition, and that enables them to hold human-like conversations. But what's important to remember, this is an illusion. They don't really truly understand or grasp the underlying concepts. Large language models have no understanding of causality. They have no causal understanding of anything. So it's an illusion that even industry insiders sometimes get swept up in this hype. And it's understandable, but I think it's important to have a very clear-eyed view of where we stand with AI. Reasoning is crucial because it signifies the beginning of this causal understanding I was referring to. It's a vital step towards what's called AGI, artificial general intelligence, not to be confused with AI, artificial intelligence. And unfortunately, the evidence suggests that machines are still missing this AGI ability. For example, consider basic logic. If A equals B, we all learn this, and B equals A, let me back up. If A equals B and B equals C, then A must equal C, right? Seems simple. But the research shows that LLM-based systems struggle with this concept unless they're very explicitly programmed. So there's a lot of room for improvement there. Another example, and we hear about this a lot, are what are called AI hallucinations. And so these LLM models can perceive patterns or objects that simply don't exist, leading to really nonsensical outputs. The hallucinations are exposing the limitations of even the most advanced models. And I can give you a few examples to illustrate. Medical AI definitely always needs a second opinion. So for example, an AI designed to diagnose skin cancer, which confidently misidentifies a harmless mole as something that's malignant, which could lead to an unnecessary procedure. So it highlights the importance of human oversight in critical applications. Another one, think of like AI news. An AI news bot summarizes current events, cooks up some juicy story about a celebrity arrest. The fabricated story goes viral before the truth surfaces. And this showcases how AI can be misused to spread misinformation. And my personal favorite, dinner reservations, a popular AI assistant tasked with booking a romantic Italian dinner for two and somehow snags a reservation at a local muffler shop instead. It seems like a silly error to demonstrate how AI can misinterpret user intent, but it leads to unexpected results. But those are just a few examples. It highlights the pitfalls of of these AI hallucinations. But imagine something like an AI stock trading platform mistaking some blip in currency exchange for a major market trend. Uh, that could trigger a wave of automated tasks based on a mistake and lead to financial instability. And we all hear about the ongoing struggles of self-driving cars, which further exposes the limitations of current versions of AI. It's real world is very messy and unpredictable, and these situations with deep learning systems can't always handle that. So there's a lot of ongoing challenges. There's no doubt that the emphasis on reasoning is a way for vendors of today's LLMs to attract users and developers. We just really need to get past the marketing hype. I think generative AI has a very bright future, and there's a lot of valuable applications and significant profit potential. But we just need to be clear, this is not the dawn of AGI, artificial general intelligence. And the problem for investors in the market is the pricing that we're seeing is really kind of a fantasy. When the inevitable reality check hits that true AGI still remains a distant dream, I think there's going to be a significant market correction. And investors today, I think, would be wiser to take a more balanced approach, keeping an eye on the one hand on the promise and also the current limitations.
It's quite interesting. So, you were talking a bit about generative AI, and that is just a fraction of the AI industry. So, how do you see the larger AI landscape? I mean, you touched on AGI, but how do you see the larger AI landscape developing, and what other opportunities might this present?
Well, the arrival of real artificial general intelligence AGI would definitely trigger a massive transformation across the whole of the AI market, with expectations shifting dramatically. Um, and that has a big impact on M&A, certainly. Some of the kinds of potential changes, I think one would just be explosive growth. AGI would signify a whole new capability of human level intelligence and adaptability. That would unlock a whole new class of applications across really every industry imaginable. Scientific discovery, automation, healthcare, creative endeavors. The possibilities are really boundless. It's immense potential that would fuel explosive growth in AGI market. And I think there'd be investments pouring in to develop and utilize those capabilities. That's one. I think it'd be easy to say as well that there'd be a lot of market restructuring. The current landscape is really dominated by companies specializing in narrow AI tasks like facial recognition or spam filtering. And that would all undergo a really major shakeup. Companies that successfully navigate the transition to AGI development and implementation, I think, would stand to gain immense market share. And conversely, those that are clinging to the outdated narrow AI solutions might really struggle to compete. We hear a lot about ethical concerns of AGI. I think that would become paramount in the future. As I said earlier, it's not something to be concerned about with generative AI because it's very different, but we would have to be putting in regulations and safeguards to ensure responsible development of what would be really very powerful technology. I think companies would need to demonstrate transparency and ethical considerations in their AGI projects to maintain trust in the public markets. I think the existential question might be, does the arrival of AGI trigger philosophical debates, the nature of intelligence, consciousness, the future of humanity? Those would all be subjects of really intense discussion. And the whole market would need to adapt to a world where machines possess capabilities that we used to think were just exclusive to humans. Overall, I think the arrival of AGI would be transformative, not just for the AI market, but for society as a whole. Immense opportunities, significant challenges, and I think the markets would need to adapt to how to address all those opportunities and challenges that it presents.
Yeah, I mean, I agree with you on all those counts. And now you mentioned investments and kind of these different opportunities. What impact are you seeing in how AI is changing tech investments for AI companies in particular and other tech companies, especially considering your tech background?
Well, I'm glad you asked that. I deal with this every day. We've got a pretty crazy situation brewing in the VC world lately. Way too much money piling into the same narrow, trendy sectors and themes, even though VC has now experienced 9 consecutive contracting quarters. There's still a massive glut of dollars chasing a very limited number of deals, fueling insane competition and artificially jacking up valuations to unrealistic levels. And sure, the nosebleed valuations look great on paper initially because it reduces the founder's dilution. But here's the catch: it sets everyone up for a world of pain down the road. With these companies inevitably needing more cash to keep growing, and in AI in particular, a significant amount of that goes to NVIDIA. These prior excessive valuations make future rounds stupidly expensive, not to mention causing severe dilution over time as these companies have to issue more and more shares. So in essence, by getting these into these valuation contests, and that could be an M&A or a venture capital financing, companies essentially dumping boatloads of money into whatever's hot at the moment. These investors are basically undercutting their own interests and their upside. So you've got a sort of a short-sighted frenzy getting into the busiest deals at any cost, which ends up cannibalizing equity ownership that those same investors could have retained at more reasonable valuations. So that combined with, I would say, ever larger funds that are calling the shots and dictating these valuations in these favored spaces. Founders get high on the valuation fumes without fully grasping the dilution hangovers that end up coming their way. And what's probably most ironic is that it's these investors who are the first ones to gripe about the overheated valuations and the irrational exuberance, but it's the raising of the bigger and bigger funds to outbid each other on a handful of themes that are causing the issues they're really not happy with. So I think both investors and entrepreneurs would benefit from valuations that are grounded more in reality rather than the hype, and that would essentially help prevent these dilution death spirals and ensure that everyone keeps a meaningful slice of the pie with actual value created long term.
Yeah, and I've seen that a lot where founders want to be acquired, but they end up being diluted and then see them thereafter. And we try on our deals to protect the founder from that happening, through the documents and the purchase agreements, et cetera. And I actually heard a podcast yesterday where basically because of NVIDIA, the only thing all the other guys can compete on is price points. And because of that, it really reduces the profit margins. It squeezes the investors. It squeezes everybody involved. So they're really running the game right now, NVIDIA.
At 20 to 30 bucks a user, you can't be profitable as a generative AI business. And a large share of all the new investments is going straight for NVIDIA equipment. So it's really sort of a transference of wealth from LPs to VCs to NVIDIA.
Yeah. Yeah, exactly. So as we wrap up here, I'd love to ask you, what best practices would you recommend for companies considering roll-ups or acquisitions?
Well, I think there's a number of considerations, and it really depends on the cycle in the market. On the buy side, obviously, on the one hand, as I described earlier, valuations in certain categories are really overinflated. But on the other hand, there are a lot of high quality companies that are not able to get new financings and could be ripe targets for acquisition at very attractive multiples. So, in a sense, it's a buyer's market from that point of view. So, I think this is an opportunity to buy at attractive valuations if you're not in an overhyped market. On the sell side, I think it's increasingly important to just illustrate what's always been true of high quality companies and high quality deals. So maintaining high growth rates with attractive margins and partnerships, I think, are really key. We see that increasingly companies are looking for alternate channels to market to get leverage and distribution. And oftentimes they become exceedingly valuable to their partner which can then result in a transaction where the bulk of the valuation is the strategic component, which doesn't have any math associated with it, but can really result in a very attractive multiple on whatever the valuation might have been otherwise.
Oh, great. Well, you guys hear that? It's a buyer's market. Now, hopefully real estate follows shortly. That's a conversation for another time.
It's Miami, right?
Exactly. Well, Steve, thank you so much for joining us. This has been absolutely fascinating. Really appreciate having you here.
My pleasure, Emmanuel. Thank you for inviting me. Have a great rest of your day.
Thank you so much. You too.